After 2008, central banks vowed emergency measures would be temporary, yet 15 years later, their balance sheets are still swollen, now at $6.8 trillion and capped. Global debt surges near 95% of GDP, and the Fed's firefighting tools are running out. How do you prepare for collapse with empty magazines? The answers and risks are far more unnerving than most people realize. Quantitative easing was born out of necessity. In 2008, as global markets seized and banks teetered, the Federal Reserve expanded its balance sheet from under $1 trillion to $4 trillion, buying Treasury and mortgage securities on a scale never seen before. This was supposed to be a short-term fix, a way to pump liquidity into a paralyzed system and restore confidence. But the experiment didn't end. Instead, the Fed's balance sheet kept growing, peaking at $9 trillion. The playbook for crisis response had changed, and extraordinary measures became the new baseline. When the COVID-19 pandemic struck, central banks moved even faster. Within weeks, the Federal Reserve and its global partners activated $450 billion in currency swap lines, flooding financial systems with dollars. The speed and coordination dwarfed anything attempted in 2008. Swap lines, once a temporary patch, became standing agreements, ready to deploy at the first sign of trouble. Markets learned to expect immediate intervention. What began as emergency action became a permanent fixture, raising the bar for what counts as a crisis and what tools are left for the next one. Now, with balance sheets still swollen and swap lines always on standby, central banks face a world where every rescue must be bigger than the last. The Federal Reserve drew a line in December 2025, halting its balance sheet reduction at $6.8 trillion. After years of expansion and only modest runoff, policymakers face the reality that further shrinking could destabilize markets or leave the system short of reserves. The Federal Reserve's arsenal, once thought limitless, now sits at a plateau. At the same time, the world's debt burden has reached levels that would have been unthinkable just a decade ago. Global debt stands at $251 trillion. Public debt alone swallows 94.7% of global gross domestic product, crowding out room for governments to borrow in the next emergency. The International Monetary Fund warns that, without major changes, public debt could breach 100% of gross domestic product by 2030. These numbers are not just abstract, they define the hard ceiling on what central banks and governments can do when the next shock arrives. With balance sheets stuck at elevated levels and debt ratios near historic highs, the capacity to absorb new crises is shrinking. The arithmetic is unyielding. Every new intervention risks pushing the system closer to its limits, leaving less and less room for error. Banks across the United States and Europe are sitting on $620 billion in unrealized losses from Treasury securities, hidden wounds that remain out of sight until market stress forces sales or depositors panic. These losses, a byproduct of years of low rates followed by rapid tightening, weigh on capital ratios and limit banks' willingness to lend. At the same time, commercial real estate faces $500 billion in loan maturities through 2025. Office towers, half empty since the pandemic, struggle to refinance at today's higher rates, raising the risk of defaults that could ripple through regional banks and beyond. Regulators have responded by ramping up mandatory stress tests. Twice a year, banks must now prove they can withstand scenarios of 10% unemployment and asset prices falling by 40%. Artificial intelligence combs through real-time payment data, searching for early signs of trouble. Yet even with these advances, the 2025 stress tests flagged contagion risks in the shadow banking sector, money market funds, private lenders, and other non-bank actors that operate outside the full reach of central bank oversight. When Credit Suisse teetered in 2023, standing swap lines between major central banks delivered instant dollar liquidity, stopping the panic from spreading. But the cracks exposed by these events remain, and the system's ability to contain the next shock is far from certain. Central banks now face a contest that extends far beyond their own borders. 134 countries are developing central bank digital currencies, racing to build new tools for crisis management and global influence. China's central bank has pushed its digital yuan to $986 billion in transactions, using it not only for domestic payments but as an alternative for settling international trade. This digital currency, backed by a growing network of swap lines, gives China leverage with partners who want to avoid the dollar. Meanwhile, the United States moved in the opposite direction, banning further development of a central bank digital currency in January 2025. Federal Reserve insists that the risks to privacy and to the stability of commercial banks are too great. Yet outside America, roughly $18 trillion in dollar-denominated debt remains, debt that depends on the Federal Reserve's policy choices but sits beyond its direct control. Policymakers call this the doom loop. Every move to fight inflation risks triggering a debt crisis, while every effort to stabilize finance feeds the very vulnerabilities that threaten the system. Today, central banks navigate record debt with limited tools and rising risks. The next crisis may demand choices their playbook cannot cover. The future of money is up for grabs.